To start off, I slowly arranged this into 3 portions. The first portion is a little bit overview why even buy gold or silver in today's environment. Second one is what we do, which is different from just about everybody else. And the third portion is some of the things that we offer, some of new type of items like electric vehicle metals and so on, and why that makes sense. So I'll start off with visualization of debt. You know, we hear billions being spent here, trillions of deficits per year and so on. And for the most part, we don't really know, we can't really visualize that. What does that mean? Is a billion different from a trillion? A lot of people don't really see that difference. So we spend a little bit of money in order to help visualize how much money that is. So you see here you have a $100 bill, you take 100 of those, you get 10,000. You take 100 of those, you get $1 million. You take 100 of those, and you get a $100 million pallet. Of course, we all would like to have one of these. But if you put it up to scale, here's your pallet. Now, these big towers here, that's $1 trillion. Now, this graphic is a little bit dated, but essentially in 7 years, between 2010 or so to 2016, the United States doubled the amount of official debts that they have, as did many other countries. So, to some degree, I think I'm preaching to the choir here, since you're all aware of this, but nonetheless, nowadays, the amount of debts have gone up a lot more. The amount of gold reserves that the United States has, more or less, is covering 1 month of governmental expenses now. And as you're probably all aware, unfunded liabilities tend to be 3 to 4 times, it's all estimates, but 3 to 4 times what the official debt is. So when we're all said and done, we might be looking at 100 trillion worth of money that the government is supposed to have, but doesn't have, whether it's deficit or questions on how to pay Medicare and Medicaid, Social Security, and so on. And in many ways, the early recipients of these things have done pretty well. The later ones, they're in trouble. I myself, I've paid into Social Security for 3 or 4 years. I know I won't be getting anything, because I need to pay 6 years to get anything. I paid into the German retirement system, not getting anything there. I'm paying the Singaporean one now. So that one actually works pretty well, because I can use that money to pay my mortgage. And if I leave Singapore, they pay it out to me. So, but overall, we have a big problem, and I think we're all aware of this here. The other big thing I want to point out is I used to work as on the structured product desk of a bank with quants building derivatives. I was in the early part of my career. I used to very much like finance. And derivatives have just exploded since I was doing this. And we have over 1 quadrillion worth of derivatives. And this graphic here, this little dot here, that's the Statue of Liberty. When we talk quadrillions, that's the amount of dollar bills we're talking about. They're such huge numbers that it's almost impossible to comprehend. And these represent the interdependence between banks in our financial system. And interdependence is a problem, because if one of these banks starts failing, it might cause other banks to fail, and that creates a contagion and a ripple effect, and the whole house of cards basically falls together. Warren Buffett, he calls them weapons of financial mass destruction, and he's right. In 2008, Lehman Brothers went bankrupt. And in 2008, I was working as a senior data architect for Germany's second biggest bank, Commerzbank. At the time, I pretty much got to see how the financial system almost came to a standstill. When Lehman Brothers went bankrupt, there was a German bank which transferred about $50 million just 3 or 4 hours before they declared bankruptcy, and the money was gone. And they were declared, Germany's stupidest bank. And nobody wanted to, copy that. So nobody in Germany wanted to transfer money to any other bank, because they might go bankrupt as well. And then you're labeled as the stupidest trader in the world. So the system came to a halt. And you have to understand, when banks don't trade with each other, everything comes to a stop. So at the time, Lehman Brothers, as we all know, went bankrupt. But look at all the other companies who needed bailout. Fannie Mae, Freddie Mac, AIG. A lot of people have life policies with AIG. Those policies are worthless if they go bankrupt. Bank of America, Citi, JP Morgan. I spelled out the numbers, 25 billion to JP Morgan, Wells Fargo, 25 billion, GMAC, and so on and so on. So it just shows how we went from a system which seemed to work fine, almost overnight, to a point where the financial system almost collapsed. And that was 2008. In 2008, I saw people get out and start buying precious metals, traders, other people, and I thought, gee, that might be a good idea. Why don't I go and buy something? And gold and silver at the time kept on going lower. I remember I wanted to buy silver, and silver went down to $9 per ounce. I thought, great, makes sense. Let me go to the store and buy some. Problem was, the store was only buying back, so it wouldn't sell me any. And I thought, well, that's a funny store, let's go to a proper store. So I went to a different store. So it was in Frankfurt back then, Germany's financial capital, basically. And they told me the same thing. Basically, once a crisis starts, you cannot find physical gold or silver. And the premium for these starting to go way up. And I tried to go to 14 different bullion dealers and banks trying to get my little silver bar, which I wanted to buy. And the more I was told that they don't have it, the more I realized that when the next crisis happens, I want to make sure I own some silver and some gold. And I finally got a 1 kg kilo bar at the gift shop of the European Central Bank. It ended up being quite funny. I told the story to the person, and he said, come back in 3 days, and indeed he got me a real silver bar. Paid 19% tax in Germany. Took it to Singapore, paid 7% in Singapore, just to figure out how it all works. And then going from there, I ended up building the bullion dealership and a lot of other things. But that was basically the beginning of it. It was the realization that when the next crisis comes, counterparty risk, having your money in a bank and so on, is something you cannot control. And you might not have access to that money anymore. And taking something physical such as gold or silver, to some degree cash as well, keeping it at your place or putting it in a safe place, that's a fundamental precaution everybody needs to take. Because we are going to have another crisis. And when this other crisis comes, this time around, I don't think we are going to have bailouts. I think nowadays the attitude towards bank has changed very much. I think politically bailing out banks again is going to be much more difficult. The governments also don't have much money left. We've been having very low interest rate for a long time. As Jim Rogers puts it, there's no powder left. So this time around, we're going to have bail-ins. And there was a G20 meeting in Brisbane back in 2014, which pretty much made an accord between the G20 members to say that this time around, next time the crisis happens, it's going to be the depositors and the unsecured creditors of the bank who are going to have to pony up and basically take the losses. So it won't be the government bailing out the banks, it's going to be, if you are a customer of Bank of America might end up taking some of that money in order to survive. That's the idea, that's what a bail-in is. And in order to organize all of this, we have the Financial Stability Board, which actually coordinates between regulatory agencies in each country to make sure that once we have systemic risks coming up, big banks basically going into failure mode, that accounts are frozen in time to prevent people from withdrawing the money. And as they're frozen, they can in a more systemic way decide who gets how much money, how much is going to be given to banks, and so on and so on. We had an example of this happening in Cyprus. That was back in 2013. In Cyprus, about everybody above $100,000 in the bank lost 48%. If you lost more than 3 million euros, you get a free citizenship of Cyprus. So it was, it might be worthwhile actually, but that was the deal. And the way it works is that money is not really just taken, it's converted into bank equity, into bank shares. But because the bank is, on the way down, that might be worth very little and or nothing. If the bank survives, then maybe you can get something back. But you have to assume that we're going to have bail-ins the next time, not bailouts. Now, if things go really bad, and some people don't believe in this, some people are more open to this idea, there is a possibility of a currency crisis at some point. As we all know, the United States has been printing huge amounts of money. So, we've got about 450% increase in the monetary stock. The amount of debt that's being created, etc., etc. And it's all based on trust, ultimately. If we take the 1920s Germany, the problem was not really that Germany printed too much money. The problem was that people lost faith in the money itself. There was a lot of money printing during the war, and it took several years for people to realize, because they used to just hoard the money and save it for a rainy day. But then slowly, as prices started to go up, they started realizing, well, maybe I ought to spend some of that money and buy a little bit more bread to keep, for a rainy day, or something I can store for a longer period of time. And then the stores, they would realize, oh, I'm actually selling out of most of my stuff, I better start increasing prices. And as people saw prices getting up, they would spend more of their money to get these items, and it would basically create this self-reinforcing trend. And as this continued, it eventually took almost incredible proportions. What you see here, this is a conversion table. This was done back in 1930s or so, when Germany went out of hyperinflation. And it showed how much, at any point in time, your debt was worth. So the way Germany got out of this was they essentially created a new currency which was backed by all assets that the German government had, because they didn't have gold. They had to give that to the French for the most part. And then later they managed to go back on the gold standard. And when it was on the gold standard, people trusted the currency again. And since they had to have a way of sort of saying, how much is my gold worth, my new gold currency, compared to my old paper currency, the Weimar marks. And this was the official list. So by 1918, one of the new gold coins was worth 1.25 Reichsmark. And you could see that by, say, July 1922, it was 105. And then by November 1923, it was 115 billion. But just think what that means. There were people who spent most of their life putting their money into a life insurance. That life insurance, at the end of the day, was not enough to buy a coffee. It was worthless. People on pensions, they basically didn't have any money. A lot of people died during World War I. Old folks, they basically committed suicide en masse because they didn't have food to eat. They didn't have income. Money became virtually worthless. I have some of these bills. It's just printed on one side. On the other side, it wasn't worth printing on both sides, basically. And since they came up with a stamp, a times 100 stamp, you use the stamp, and your bill is no longer 5,000, but it's now 500,000 Reichsmark. That's how crazy this whole thing became. So it is possible. It happened before. And what also happened before is gold nationalizations. When a government has its currency questioned, it has a huge problem, because how do you pay your army? How do you pay your civil servants? How do you pay for expenses? So it is quite natural that a government will go back and nationalize gold if such a crisis happens. In 1933, the nationalization happened because there was a gold standard in the US, and the government needed to print more money. And if it would have allowed citizens to convert printed money into gold, then there would have been a problem, because people might have converted all of this. So the solution was just to make it illegal to own gold, and that allowed Roosevelt back then to basically build the Hoover Dam and all these other things. Nowadays, the government is printing as much as they want, and it's all based on the full faith and credit of the United States, nothing else. So, why would they nationalize now? Well, if you have a currency crisis and people don't trust in the US dollar, and you have a similar effect as what happened in Germany, maybe not as severe, but say it's starting, in order to stop that, they would have to back it with something solid. Hence gold, hence the idea of going back to it. And I would like to say the system overall is unstable in the sense that imagine people being at a movie theater and watching a movie. And one guy starts running out towards the door. In general, people would just say, well, that's a crazy guy, must be running to the toilet or something, but doesn't care much. But now assume 3 people are running towards the door. People get a bit nervous. Assume 7 people are running. I bet you an 8th person is also going to run out. And then a 9th, a 10, 11, 12, 13, and suddenly everybody is rushing towards the door. So that system has gone from stable to unstable. And there's that critical number, it might be 7, might be 8, that basically gets it to switch very fast. And that's something that is a possibility that might happen, and hence the need to store some gold or put some of your wealth outside of the financial system in general. Because the egg basket can all go that way. So that was basically a quick sort of survey why gold and silver in general, coming from a systemic point of view. Now a little bit about what we do. Essentially, we store gold, we store silver, we now store nickel and cobalt, which are electric vehicle metals. But we store it in a way which, as we like to say, is the safest way in the world. And I kind of say that's a challenge because I like people to challenge me about it and kind of tell me what it is we can do better. In the last 9 years, I spent almost all the time listening to people, giving improvement ideas or seeing how we can improve it. And it's quite difficult to explain all the different things we do in a compact way. And I've been trying to refine the way I do that over the years. And there are basically 4 points, which I think are the most important. The first thing is, when you are buying some gold and you're storing it with somebody, and by the way, why do you want to store it with somebody if you can just keep it at your house? Well, you can do that for a certain amount, but if you really do have a gold nationalization, as happened in 1933, your gold becomes like cocaine. You can get arrested if you have it. So it becomes difficult to use your gold and convert it back into cash. You put it in a different jurisdiction where it's legal. Can somebody convert it for you and send you back cash and so on? So it makes sense putting some gold with somebody else. But you might have all heard the saying, if you can touch it, you don't own it. And that's a very true saying. Because in most cases, you really do not own your gold. And that was one of the first points I'm bringing up here. If you store gold with somebody, make sure you're an asset owner, not a creditor. And how do you do that? Because there's a lot of confusion out there on what that means. And before we go into this, we basically built our own vault in Singapore in order to enable all of these things. And this is a short video to show you what it's like. This is John, he's here by the way, he's the director at the Safe House. The Safe House is a storage facility in Singapore. We're storing up to 600 tons of gold and silver. And it's protected by Singapore Auxiliary Police. This is fully owned and run by us. We have safe deposit boxes that we have. Small ones can store up to $650,000 or so worth of gold, 500 ounces. It can be fully insured. 200,000 insurance comes with a box. The additional one is 19 basis points per year. We also have very big boxes, 205 kilos. Which is quite useful for silver. You can see here, this is the entrance of the main silver vault. Right now we're storing around over 200 tons of silver. They're being stored in these pallet cages, as you can see here. Each one is about 900 kilos or so. And what's relevant here, each parcel belongs to a single customer. We have a gold vault, which is inside the silver vault itself, and we are storing the gold in the safe deposit-like boxes. We are also testing bullion. As an integrated testing lab, we do X-ray spectrography, we're doing ultrasound to look inside the bank. We're doing electrical testing as well. The bullion then goes into parcels like this with a unit ID. The parcels go inside the pallet cages, and the pallet cages go into the racks. These are then locked with seals, and it gets audited by PwC once per year, 3 times per year by Gregor Gregerson. The facility is a tax-free facility from Singapore Customs, 9001 certified. And we have one of the best insurances in the world, which shall be coming in about pretty soon. Now, this facility allows us to do things differently. And so one of the things which we do is what I was alluding up earlier, which is how do we ensure that you're an asset owner, not a creditor? The way this works is, you might have heard the term fully allocated. In the industry, you hear that a lot, and oftentimes people tell you fully allocated is a good thing. What fully allocated basically means is that if you have 4 people and each one gives you, say, $10,000, you take these $40,000 and you buy a gold bar. And then you say 1/4 of that bar is yours, 1/4 is yours, 1/4 is yours, 1/4 is yours. But legally, only one entity can own that bar. And who's that entity? Well, that entity is the bullion dealer. And you are a creditor. So there's no way for you to own a partial bar. You're always going to be owed something, not be the owner of it. And that creates a lot of problems once you start thinking about it, because there's a big incentive for the dealer to maybe not have all the gold there, or even if all the gold is there, it can be encumbered, it can be used, it can be leased out to somebody else, or what happens a lot is it's being used as inventory. In other words, if all that gold is there, I might as well sell it to some other customers, and I'll just reorder some gold, from my suppliers, and I just keep on going like this, which basically means the customer is subsidizing the dealer. Now, if the dealer ends up going bankrupt, you have a problem because you are a creditor. So fully allocated is not a great system when it's for the customer. It's a very convenient system for the dealer, but not for the customer. So I didn't want that, because my goal is not to be convenient for us. My goal is not to cut corners. My goal is to create the most transparent system possible, and a system which is going to survive whatever is going to be thrown at it within practicality. So what we are doing is segregated ownership. And what that means is we as a company, we own about 250,000 ounces of silver and about 2,000 ounces of gold. That's our own capital in the company. And we parcelize it. And when you buy gold, you're basically buying it directly from us. But most importantly, it's going into a bag like this, if it doesn't have a serial number. If it has a serial number, it's uniquely identified. And you then get an invoice with which you buy that specific bar or that specific parcel. And that makes you the owner of that specific bar under Singapore law. And we then have to make sure that we put this bar in the right place, and then we can find it again. Because when you come to the vault and you want to say, I want to have my 3 bars, we cannot just take the first 3 bars. We're going to have to find exactly your number. PwC, big auditing company, which comes in, you have a parcel ownership list, they're going to check each one of these bars. Or now, because we have so many, it's about 40% that's being checked. So that means we cannot cheat. It also means if we were to go bankrupt, it is not going to affect you, because creditors cannot access that bullion. It's not on our balance sheet, it's yours. There will be solvency manager coming in, making sure you get your gold back. Now, having said that, we have 0 debt, we got $10 million in equity in the company. We have enough money from storage to run it indefinitely. So it's not like we're going to go bankrupt. But it is the type of stuff which you ought to be thinking about if you're storing your gold with somebody else and you're using fully allocated. Because if that company goes bankrupt, you have a problem. Fully allocated does not mean ownership. The next point is exclusive Singapore jurisdiction. And by the way, all these things are described in much more detail on our webpage. So you can easily, if you're interested, find out more. And what I mean with exclusive Singapore jurisdiction, this is the reason we built that vault. Because when I started the storage system, I used to outsource to big commercial vaults, which pretty much everybody else in the industry is doing. And I found a lot of problems with that. And the only way to surmount these problems was to build our own vault. And essentially the industry works like this. We've got a bunch of dealers, and these dealers will subcontract the storage to international vault. These are companies like Loomis, like Brinks, Malka Ahmed, and so on and so on, G4S. And these vaults would have locations in multiple countries. They typically would have something in the United States, probably New York. They would have something in London, maybe Dubai, Singapore, Switzerland, maybe Hong Kong. So they will basically be global entities. Now, typically, people think, or in the past, people said, well, being global is good. It means you're big, it means you're successful, and so on. But it's just like having a passport. And if you have a US passport and you ever tried opening a bank account outside of the US, you kind of realize that there are downsides sometimes to having a passport of a certain jurisdiction, because you're unable to open a bank account for various reasons. And it's the same thing for these sort of vaults, because if you are a US-based company and you're storing gold in Singapore as a vault, or you have a lot of exposure back to the US because you're operating vaults in the US, what are you going to do if the US is going to nationalize gold? Are you going to follow US law, or are you not going to follow US law? And that's the hard question I kept on asking to these vault operators, and they didn't like that question. And normally I would get answers saying, well, depends on the lawyers, it won't happen, and so on. Sometimes I would find very straightforward people and tell me, well, I will go right back to the US. And ultimately, that's the truth. Because you think about it, if a bank like BNP Paribas, a French bank, which has been dealing with Cuba, and the United States comes and says, oh, you're a bad bank, we have sanctions against Cuba. And the bank says, yeah, but I'm a French bank, that's American sanctions. The US says, no, you're going to be paying me $2 billion or whatever it is in fines. PNP will pay the $2 billion. Why? Because all US wire transfers have to go through New York. And the United States can basically block BNP Paribas from doing business. So nowadays, everywhere in the world is more or less following what the US wants to do, which is why we have FATCA, why we have all these other legislation, why data comes back to the US. So if a vault is going to, if the US decides to nationalize, and you're storing your gold, say, in Switzerland, or in Singapore, or in Hong Kong, and you're doing it with a company that is internationally exposed like this, chances are the gold is going to go right back. And most people are not going directly with a vault, they're going through a dealer. And the dealer is always looking for the lowest price, and the lowest price are these kind of companies. So if you're buying the gold to protect yourself from a nationalization, you have to look more into this. What they're telling you is that if Burundi says that all gold has to be nationalized, then in theory the vault can send the gold back to the Burundi government, and you ought not to be able to sue them. Now, of course, nobody cares about Burundi, but what if the US wants it? Right? Which is why I did not want to outsource the bullion storage. The only way to do that is to build your own vault. And that's basically what we did. Silver Bullion is basically the dealer. Our fully owned subsidiary is the safe house, which you just saw the video. And we only have Singapore jurisdiction. And that's what I mean when I say exclusive Singapore jurisdiction. We basically don't recognize US authority. We had a case where one of our US customers went bankrupt and some Texas court wanted to requisition some of his assets. Well, we just contact the customer saying, what do you want us to do? If they don't want us to release it, we just tell, say, US court, go through the Singapore system. And, that takes a long time. So we basically only have to follow Singapore law. The reason we have to do that is because we have no real exposure outside of Singapore, and we did this by design. And that's unique about us. And that's why when a nationalization happens, I've basically trying to make sure that gold is going to be safe, because I think it's going to happen. And that's why we created the company, to be a safe haven, basically. Now, a lot of people might be interested about reporting and so on. If you are going to store your gold or silver somewhere, you know about FATCA. FATCA basically is US legislation which requires just about every jurisdiction in the world, with the exception of maybe North Korea and Iran and so on, to require its bank to forward all transaction information as information about potential US citizens doing transactions in that country. And if the bank does something which the US government doesn't want, it can penalize the bank. If the US citizen doesn't pay their taxes, the bank can be penalized for doing it, which is why most foreign banks don't want to take US customers anymore, because it's too much of a risk. Talking with head of compliance for ABN AMRO, Asia, he was saying unless the customer has like $5 million, we don't talk about opening a US account. If it's that amount of money, we can afford having somebody running after the customer. But if it's below that, they no longer want to do it. Even Loomis, which is the biggest vault provider in Switzerland, does not take US customers anymore because they're too scared of the consequences of having US customers. Now, FATCA only applies if you're a financial institution. So what makes you a financial institution? Well, the US definition of financial institution is very vague, very large. It says, among other things, if you're dealing in commodities, you can be a financial institution. So the grocery store selling an apple to somebody could be seen as a financial institution under that definition. And in the intergovernmental agreement between Singapore and the United States, when it comes to FATCA, Singapore did not agree to that definition. And they changed it to say anybody dealing in commodity futures. We're not dealing in commodity futures, we're only dealing in physical. Which is why we are not a financial institution under Singapore law and under the treaty between the United States and Singapore when it comes to FATCA. So, on a good side of news, there is another piece of legislation in Singapore, which is the Personal Data Protection Act, which actually makes it illegal for us to release customer information. We can be charged up to $1 million for doing so. So essentially, we are an entity which is just under Singapore law, and it is illegal for us to release information back to the US. Now, that doesn't mean that you don't have to report something. Half of the tax advisors in the US told me that if you open an account, you store gold with us, you should be reporting it. The other half is saying you don't have to. It's a complex thing. There's some gray area in there. But there's one thing which is very clear, which is if you put it in a safe deposit box, since the IRS very clearly says it's not a financial account. So when you store with us, there are two ways you can do that. You have it stored in these parcels, which allows you to buy and sell online. You can take a loan around it. Or you put it in safe deposit boxes. In which case, I'm quite certain you don't have to report it. But again, that's something for you to look at, because even so we are only falling under Singapore jurisdiction. If you're a US citizen, of course you're falling under US jurisdiction. So you have to be aware of what your taxation requirements and statuses are. That brings me to my next point, insurance. The second clause, which caused me to open the vault, is this clause here, which used to be very common in vault statements. It basically says that the vault shall not be liable under any circumstances whatsoever for shortage or mysterious disappearance or unexplained loss from or damage of the goods said to be contained in parcels. In other words, if your gold mysteriously disappears, it's not insured. People will go, what's the heck? Well, there's a reason behind it. Let me preamble, we got mysterious disappearance insurance. But the reason why it's a big deal to get this is, look at it from the insurance point of view. If the insurance is going to insure you for, say, $300 million, if somebody comes in and steals it, I have to go and get a police report. And the insurance will then look at the police report and say, okay, yes, this really happened, I'll pay the claim. If there's an inside job and we can figure out what happened, same thing, we have a police report. So it's kind of safe with the insurance. But if it's mysterious disappearance, by definition, we don't know what it is. And it could just be that maybe we got a shipment of 100 bars of gold and we didn't do a good job counting it. And there were only 99 bars, but we thought it was 100. And then 2 months later, we go and we find out there are only 99 bars. That's a case of mysterious disappearance. If we go to the police and we say, oh, we thought there were 100 and only 99, the police is going to say, well, too bad. Right? It's not going to file a police report. So for the insurance to give you mysterious disappearance coverage, they have to trust you very much, because they have to insure any potential errors that we do. And vaults normally don't want to pay the cost of that, or they don't qualify because their processes are not good enough. We are sort of a new vault. We've been around 9 years now only. So I figured we're kind of like Avis, we have to try harder and we get to get that insurance, and we did. So how can you tell if somebody has it? Because we found out there are quite a number of dealers which are claiming to have it, but actually don't have it. One way is most dealers nowadays should have an insurance certificate. The insurance certificate will say what is covered. This is ours in this case. It will say mysterious disappearance, among other things, including sabotage and terrorism. Actually, we keep going trying to add more items. But you should be aware that what typically happens is people never get to see this document. Instead, when you ask a dealer and you ask for insurance, they will tell you, oh, don't worry, it's got all risk insurance. Now, all risk insurance is a technical term. It means all risk included unless excluded. So it doesn't mean anything. But oftentimes, customers go, oh, okay, yeah, all risk insurance, everything, I don't have to worry about it. It's safe. It's not. And sometimes the dealers themselves don't know that. So you have to look at exceptions. If somebody has mysterious disappearance, you're pretty much covered. That's the hardest one to get, and it covers everything that's not explainable. Explainable stuff is easy to cover. So another thing you should be aware of, if you go to a dealer and you tell them, I want to see my gold, I want to see my silver. If he tells you, oh, we cannot because security, most likely they're trying to hide something. Because security is determined to a large degree by the insurance. Because the insurance is the one who's going to have to pay if something goes wrong. And I've been building the vault, I've been dealing with insurance companies, I've been getting insurance which is much better than most others, so I know security. And the insurance never had a problem for us to show customers the location. So when somebody tells you, oh, you cannot see it because of security, they're trying to hide it because the gold might not be there, because it might be stored in a way which is not very pretty, or maybe they're outsourcing it and they just have a hard time getting clients to be able to see the gold. That's the reality. So don't take the argument about security. And just think of it this way, if the dealer is telling you nobody should know where the vault is, well, all you have to do is go to the airport, follow the Brinks truck and see where it goes, and you would know where the vault is. And there's a media stance where a reporter goes to the vault and they're blindfolding him and turning them around and driving them around the block and then unfolding them inside the vault. And then the reporter writes about how good security is and so on and so on. And it's just a marketing stunt. So vaulting is not as James Bond-like as it seems. There are much more base reasons why people use certain things. Don't let people tell you security is the reason you cannot see the gold. And ultimately, all the stuff doesn't do you any good if the gold is fake. So very early on, we've tried to figure out how can we make sure the gold is real. We essentially are using, that's a very interesting tool which came out maybe 6 years ago, which is X-ray spectrographies. They're basically guns that shoot X-ray on a surface, it bounces back, a spectrometer which analyzes the results and it can tell you surface composition to a very high level of certainty. By itself it's not enough, you have to look what's inside the bar. So you can use ultrasound or you can use electrical conductivity measurement in order to do that. You will then do a density test as well. And essentially what we created is a tolerance database for about 300 different Bullion products. And when we get Bullion in, which is transferred from a customer, say, we will go through the testing process. It will be under CCTV camera. It will then be parcelized under tamper-evident bags. And the test results will be going online. The tolerance database will basically say it's okay or not okay. If it's not okay, we will basically send it back to the customer along with a video showing how we opened it, tested it, and how it went back. But to make a long story short, it's making us unique because in reality, in this industry, nobody ever checks the gold. If you're dealing with a dealer who outsources, the dealer never gets to see the gold. The vault, on the other hand, doesn't want to get into the issues of figuring out if it's real gold or not. For them, it's a said to contain basis. You're telling me it's gold, I'm assuming it's gold. So people, when you ask these questions, will tell you, oh, there's a chain of integrity, you know where it's coming from, and it's true to some degree. But it's also true that bullion dealers buy back gold from somebody, or that gold might be transferred in from another location. Then you don't really know. That's why you need to test. In our case, you can actually transfer your gold. Say you're having gold at, I don't know, gold money, bullion vaults, somewhere else. You can transfer it to us. It will go through that process. Once it is through it, you have full liquidity with it. You can buy it, you can sell it, you can take P2P loans, and so on and so on. So, those are essentially the four things that we've created, which are different from just about everybody else. As a quick summary, you're storing with us, you're always the owner of it under Singapore law. It's basically private property. The information of you buying it, we don't have to report it to anybody. It is the safest place, in my opinion, in case of a nationalization. Singapore is the safest place. I don't have time to get into it, but I'm happy to talk about it at our booth. We have the best insurance money can buy. And we test the bullion and we guarantee it. Because if for some reason it's not true, we will make up for it. And I don't think anybody else has a clause like this in their user agreement. Which now goes me to what we actually can do, or what you can actually buy through us. Gold, silver, now we have a new product, cobalt, and nickel. These are electric vehicles. Again, these are two very unique products. Almost nobody is doing these. It's a recent addition, and it's basically allows you to participate in the electric vehicle boom, which is coming. I know a lot of people haven't read much about it, but it's a real thing. China is producing buttloads of these cars, and they're going to have shortages of cobalt. So we have cobalt has gone up 300% over the last 2 years. And these batteries are going to need more and more nickel, because nickel is what keeps the charge. Anyway, I'll get in more detail of it soon. These are the parcels that you can buy. About gold, why would you buy gold? I always say gold is the wealth insurance. Gold is money. Gold is something which for 5,000 years has maintained its value. And if you look at gold back in 1913. I'm using 1913 because that was when the Federal Reserve was created. Back then gold was $18.92. If you would have kept it for the last 105 years or so, today it's 1,250. On average, you would have gained 4.2% per year in nominal terms, in US dollar terms. At the same time, dollar bill from 1913 is still worth $1 nowadays. but it lost over 96% of its purchasing power. So you don't want to keep large amounts of money in cash because it's a depreciating asset. You are guaranteed to lose due to inflation. And on average, since 1913, you lost 4.2%. Right now it might be less. At some point it might be higher again. But why not just buy gold? Because you're going to, on average, have a gain of 4.2%. So it's an insurance, but it's also an insurance which doesn't cost you much because it tends to go up over time. Silver. So instead of going into why buy silver, I like to bring up silver and gold ratio. Silver and gold, they kind of tend to go up and down in price. And over time, if you measure silver not in terms of dollars, but how many ounces of gold you need to buy said silver, or as a way around, then you will find an interesting relationship where sometimes silver is very cheap, sometimes silver is very expensive. And if you were to follow a rule that you would buy gold when the ratio is around 50, meaning you need 50 silver coins to buy one gold coin, and sell the gold for silver when it goes up to 80, and you do this over the years, you'll be doing extremely well. And we have a little calculator on our website where you can play around with these numbers. But for example, if you study 1985, and you buy a gold coin, and then by the late 80s, you sell it over here, you would have 80 ounces of silver. You then kind of wait for this ratio to go down, which would have been back in 98 or so. You use your 80 silver coins to buy gold. Now you got 1.6 ounces of gold. You then wait for it to going up again, and you go back into silver. So you got 136 ounces of silver. You go down here, you got 2.7 ounces of gold now. 221, 447, 358, and right now you would have 4.57 ounces. Basically, it's relatively straightforward. When silver is very cheap compared to gold, buy silver. When gold is expensive, compared to when silver is expensive compared to gold, then buy gold and sell the silver. And if you do that, say over 30 years, you just make 4 trades or so, then you will basically be doing very well here. Okay, EV. Now I'm being told time is running short, so I won't be able to talk as much about EV as I want, but essentially as a quick summary, battery prices have fallen 80% over the last 8 years or so. Partially because batteries are getting a lot better, which means that these electric cars, whereas before they were always golf carts, are now becoming increasingly powerful. Yesterday we were driving a Model X. It was acceleration of 2.9 seconds to 60 miles an hour. These cars are getting fast, their range is getting better, and so on and so on. Now, China is very much pushing this. They're basically requiring 12% of new cars to be EV. And they're wanting to kind of leapfrog to become the world's supply of EVs. There are 400,000 EV buses already. An electric car only needs 1/6 or so in fuel costs to run, because electricity is much cheaper. It's 10 times more efficient than a combustion engine, the engine. The only problem is the battery. The better the battery, the better the car is going to work. To make the battery better, you need to put more nickel in, because nickel is what keeps the charge. You need cobalt to prevent the battery from exploding or burning up. So cobalt is 6 times more expensive than nickel. So the goal right now is to increase the amount of nickel, which is going to drastically reduce the costs. As we're reducing the costs, there's a projection here of when electric powertrains are going to match ICE, meaning when an electric car is going to cost the same as a combustion engine. In the US, we expect that to happen in 2024 or so. In the EU, because of different economics, it's probably going to be 2021. But when that happens, you can expect a lot more people going into EV. And this is without subsidies, by the way. Once you add subsidies, that's being moved forward. So there's going to be a lot of EV supplies that's going to come. We have a video here which explains a lot about this. I'm going to skip it because we don't have time. I very much invite you to go to our website and look at it. And that brings me to the last portion, which I really wanted to share with you. 4 years ago, I had a customer ask me, I have gold with you. I need money, I don't want to sell my gold. Can you give me a loan? The answer was no, we are not a financial institution, we cannot do that. But then we worked on it and we realized that we could actually do it by allowing one customer to lend money to another customer using the gold as collateral. And under Singapore law, that is legal. We have gone through the Monetary Authority of Singapore, which basically approved the system. And the way it works is you are a customer, you have cash, you basically can do a lending offer. You can say, I have $50,000, I'm willing to lend it at 4.25 for this example. A borrowing request with somebody who has gold, who needs at least $100,000 worth of gold, he might say, yeah, 425 is too high, how about 3.5? So it's a bid and ask system. Now, they might eventually agree to say do a deal at 375. And then a contract is made between the two. And we would lock the bullion and forward the cash, which we already have from the lender, to the borrower. When the loan duration is up, the borrower would return the funds and we return it to the lender plus interest. You would have 200% worth of collateral, which makes it very safe. If during the duration of the loan, the collateral were to go down to 125%, we send a margin call. At 110%, we liquidate the gold. So it ensures that the lender always is covered for interest and principal. And the interest rates themselves, as explained above, are basically on a bid-ask system, so the people decide amongst themselves. Right now, these are the latest numbers. We had about 50 million USD in loans so far, about 2,400. Some loans might be $4,000, some loans might be $400,000. Interest rate for 1 month are 2.46 PA, meaning on an annualized basis. So you're actually paying 0.2% for 1 month. 6 months, 3.58, 12 months, 4.16, 24 months, 4.55. People just like to have a higher interest rate if they lend out money for a longer period. And if you go into the system, the collateral is basically the bullion stored with us. This is the type of information you get as a lender for the collateral being used as collateral. You will see the photo, you will see basic information when it arrived at our vault. You will see here that the valuation right now is in US dollars 8,200, and that a loan is being put of it. A loan is being sought for it for about 4,000. So that's pretty much the peer-to-peer side. And this is a short video which kind of explains the process. Now, there are some interesting tax implications here too, because say your gold has gone up and say you're reporting this, you can just take a loan and pay interest on it, and you don't have to pay capital gain tax because you never sold the asset. Some customers, they actually lend out some money to pay for the storage fee. So they're storing gold with us, lending some funds to somebody else, so they don't have to pay a storage fee. It evens out. Some customers like to buy some gold as they think it's going to go up a lot more, or some nickel, and they take a loan for 50% and buy more nickel with it. You can do whatever you want with that loan because we have the collateral. We're not worried about you defaulting on it. That's why we have the 110% rule. And if you are late paying back, we actually have what's called a sweeper fund, meaning we have about $500,000, which is there to make a micro loan to the party which is late, to make sure that its counterparty is getting the money on time. You can think of it like an insurance to prevent late payments. The reason I don't want late payments is because you can easily roll over loans with this. So if your loan is 1 year and after 1 year you want to just renew it, you can easily do so because the loans always start on the 1st, the 8th, 15th, the 22nd of the month. And so I don't want to have late fees, things being delayed. If somebody's paying late, we have a 1% late charge, which basically then goes into the sweeper fund and it makes the sweeper fund grow. So it's a self-adjusting process essentially. We have, on the 2,400 loans, we had no late payment yet. I mean, some people have been late, but the sweeper fund basically covered it. So it's been very reliable. If you look at it from a counterparty point of view, you're lending money to somebody who has 200% worth of collateral stored with us, with all the security things, fully insured. If the financial system goes belly up, that loan is still good. It's outside the financial system. And our problem is, we have too many lenders. We have too many people wanting to actually lend out the money. We don't have enough borrowers. Because in some ways, we are having a very... we are too careful, basically. You know, you have to have $200,000 worth of gold to get a $100,000 loan. But at the same time, we are doing this because we don't want to be in a situation where we have to liquidate your bullion. And if we have a big crisis coming, things can move very quickly. So we're always trying to be very conservative, low risk, and so that's basically what the peer-to-peer system is. Here you're seeing the lending and borrowing requests. Once something's agreed with, then basically everything goes by itself. It's highly automated. Okay. Well, the video is pretty much over. I know we have to stop it. It will be less than a minute now. Yeah. So I wish to talk to you a lot more about a lot more things. I didn't really get to talk much about EV. If you come to our stand outside, I'm happy to kind of explain a lot more details. Our website has pretty much summaries of all of this as well. We have a report to McKinsey, which is a very well-respected consulting company, especially on EVs in nickel. I highly recommend you to read it. It has a very good risk-reward sort of setup, and it's something which we're very excited about. So I'm sorry I cannot take any questions, but please come to our booth and then we can go from there. Thank you very much.